Hello and welcome to the Ally Invest Daily Service Show. Today on our show, our theme is a basic option strategy called a covered call. We'll discuss how to place a covered call trade in your Ally Invest account. Today we have with us Tamara Golub and Sean Kuhn from our Ally Invest Customer Service Desk. Sean will start by demonstrating how to enter a covered call in the Ally Invest live trading platform. With that mentioned, though, our viewers are the ultimate drivers of the content of this show. If you have any general questions about the platform, please start by putting them in the chat box right now on the right-hand side of the screen. I have to point out, for privacy concerns, that we can only answer general questions about the platform, and please do not put in account information or contact information in the chat box for all to see. The goal of our show is to help out as much as we can in this open platform without compromising the safety or security of your accounts. Now I want to pass the reins over to Sean Kuhn from the Ally Invest Customer Service Desk. Hello, Sean.
Good morning. Thank you, Brian. It's nice to be back, and welcome, Tamara. So you can see the screen here. This might look familiar from our previous sessions. We've got our test account on this screen, and covered calls are a common popular strategy with our customers. What we're going to do first is demonstrate how to initiate a brand new position in a covered call. And I will describe what that is. A covered call is purchasing a stock and then selling a call against that stock, which generates income in the form of the premium you receive. So if you go from the dashboard, we're on the dashboard page, go to research. Now, what we're going to select here is options, because a covered call is an option. Excuse me, I logged out there.
All right. So with that said, let me just discuss a little bit of what a covered call is, and Sean will let you log back into the account. So when you're looking at covered calls, the strategy, a covered call in general means that you have to be covered. So it's a strategy that enhances your stock portfolio. So if we have 100 shares of stock in your account, so you have to be able to buy at least 100 shares, and that's because most option contracts represent 100 shares of the underlying stock. Now, Sean's going to do a specific example here, but overall, if I'm doing a covered call, what I'm saying is that if the stock gets up to a specific price, and that price is called the strike price, well, then you can call that stock away from me at that price if you are the owner of that option contract. So basically, with covered call writing, people that are buying options get that right if they would like to exercise and buy the stock. The people that are selling options are getting paid now. They bring in cash now for saying they'll take on the obligation to sell their stock at a later date. So it's fairly important. And in this account that Sean's going to bring up, we have a couple of test positions. It's just a test account. But one big thing to understand is that if you're doing a covered call, you need to have 100 shares of stock in your account in order to be able to either place it all as one trade, which Sean will show you how to do, or to leg into it, which means I'm going to buy the stock now and maybe sell the call later, which is actually the more popular way of doing it, mainly because most people that buy the stock don't want to sell it right away. So a lot of people will wait until it gets to a certain price that they wouldn't mind selling it at, and then selling that covered call against the position that's in the account. Well, and I see Sean now has his account up and is sharing his screen again. So I'll let him go through the steps of how to enter that covered call inside the Ally Invest live trading platform.
Thank you, Brian. And from the dashboard, let's go to the research page and select options. Now, for the test purposes, we've got Siri as our stock here. And you'll notice on the, what we've got here is the option chain for the stock that we're going to both purchase and sell a call against. So calls are on the left-hand side, as you see here, and the stock's trading at 634. So let's say we're going to sell a $9 call. what you'll do here is select on the left. If you click once, that's a purchase. But what we're doing is clicking twice, which means we're going to be selling a call. We're giving someone the right to buy our Siri from us at $9 when it expires in 25 days. So we've selected sell here. Now it's very simple. All we're doing is adding stock. You'll see it defaults, the system already knows that we're referring to Siri. But what's going to happen here on the trade ticket is we're going to simultaneously purchase 100 shares of Siri. Like Brian mentioned, it's always at least 100 shares, and selling one call. We're going to be paying for the stock, and we're going to be receiving not much premium in this case, just $3. If we were to sell on the, actually there is no bid, but if we got the midpoint, we get about $3 for this covered call. So let's see what the trade ticket looks like.
Right, and I would highlight here that it's serious. It's just a test position that we have in the account. It's a $9 stock, so there's not as much premium in on it overall, just because of the low price of the underlying stock.
So the same applies here like we did in previous classes. You could do a market order, which would be the going rate for both the stock and the option, or you can select a limit. Now, this will always be a debit when you're doing a covered call. Debit means you're paying for the position, and if you're doing a covered call, it's always going to be a debit. But we'll stay with the market order here. We'll preview the order. We're not going to place this order, but what you'll see here is we'll be simultaneously buying 100 shares of Siri, selling the call for $9 for an estimated cost of $634.
I have a question. I have a question actually for Tamara, if I could pass it. Tamara, on the customer service desk, do you see more people entering market orders when they're doing covered calls, or do you see them using the limit order feature more often?
Thank you. That's a good question. I actually see people using it as a limit order to prevent them from overspending more than what they intended to.
All right. And I think that that's normally the case also in that. In the options world, you have a little bit wider bid-ask spreads than you usually do in the stock world. So because of that, in general, when most people trade options, they will use limit orders just to try to assure the price that they're going to get. Now, realize that if you do enter a limit, or you say, I want this done for, in this case, it would be a net debit to the account, that there's no guarantee of an execution. You're just saying that this is what I am willing to pay for it, and I'm not going to pay 1 cent more. I'll be willing to give up that execution just to make sure that I get my price. And that's kind of a more common thing that we would do with covered call writing overall. All right. So I guess I'm going to send it back to you, Sean. I don't have any questions yet. If you have any questions, please make sure to put them in the chat box right now on the right-hand side of the screen. As I said, anything is game here as long as it deals with the Ally Invest live trading platform and it's not anything specific about your accounts. All right, back to you, Sean.
Thank you, Brian. So there's another way that you can have a covered call position. And this is, let's assume on this test account that we already own the stock. So in this case, you'll see Siri, we're long 2 shares. Now, if we were long 100 shares or say 200 shares, we could sell a covered call for 1 or 2 contracts. Now, this is easy here. What we'll do is simply select these 3 dots next to my Siri position and option chain. And you'll see it's giving me the familiar option chain you just saw a moment ago. The only difference here is we won't be buying the stock. We'll just simply be selecting the call that we're going to sell. I can even show you the $8 call here. Double click again. And your trade ticket here will initiate the covered call for your existing Siri position. The difference here is we will not be adding a stock because we already own the stock. Now we have, if we don't have any questions, Brian, I could discuss another strategy called a married put. Would you like to take a look at that?
Yeah, well, and also when you're doing that covered call trade, the way that you're entering it, what would that be referred to? If you already own the stock, how would you, what's the vernacular used to say, this is how I'm going to enter my trade?
So the lingo we use in the industry, that's what's called legging in. So think about there's two legs to that trade. The first leg is buying the stock. You may hear that term if you were ever confused about what legging in means. That means I want to leg into a trade. It means I want to add another leg.
All right, yeah. And so that, and in general, when I think of covered call writing, and then we'll go on to the married put thing, because I don't have any questions at this moment right now. But if you look at covered call writing in general, legging into that position is a more common thing to do. And if you just think about the general investor, when I'm first going out and buying that stock, I'm usually buying it because I'd like it to obviously go up. I don't really want to cap my upside at that moment. So a lot of people will let the stock kind of do what it does for a week or two, or maybe a month, and then go on out and decide what strike price they would be willing to sell that stock at. So from what Sean showed you with inside the option chains, that covered call position on Siri or Sirius satellite, we would be looking to sell the stock at that strike price of $9. So legging into it is a much more common thing to do. And one of the problems that we have a lot on the customer service desk is people are trying, because they know the strategy is a covered call, a lot of times they will be trying to enter it as a covered call and looking for a covered call ticket. But overall, if you're just legging into that trade, you're just going to be doing a general sell order that is going to be covered by the stock that's already inside your account. Now, we have a similar position, and once again, this is a strategy that enhances a stock portfolio, and as opposed to a covered call, this is called a married put. Goes by many different names. Protective put is also another name, and this is one way that you could use options to protect your 100 shares against a downward movement of the market by buying a put. Now, in this instance, we're going to be paying for that put option, and because we're paying for that put option, we get the right, and our right will be to sell the underlying stock at that strike price. So when you're buying protective puts, your strike is usually below where your underlying stock is, because you want the market to be able to run a little bit, but if it gets down to a certain level, you want to stop the pain and have the right to be able to sell the stock at that strike price. So with that said, I have one question here, Sean. Then I'll let you get into just showing the difference between the married put or the protected put in the covered call. We have Stang is back in the chat box and says, what if I sell my 100 shares of stock? Do I have to close out my option position? And I'll send that one over to Tamara. Do you have a good response for that one, Tamara?
Yes, thank you.
Mm-hmm.
In this case, it would depend on what option level you're approved on your account. If you're only approved to have covered calls in your account, that's options level 1, then you would need to close out the options position as well. But if you can do naked calls in your account, which is a higher level of options trading, then you could sell the stock from the account.
Right. Now, the naked options trading or the uncovered options trading, how often do you see clients having that level of approval, Tamara?
Actually, not quite often. I've mostly seen clients that like to do covered calls for the protection.
Right, and it's very true. And to kind of bring in some cash that gives them a little bit of a small pillow to land on their stock, lowering their cost basis overall. So if I were to do that covered call trade, and you're selling the 100 shares of stock, what order do we have to do it in? You
can place it in as one order. do it again from the options chain together, sell the stock and close out the option, or you can close out the option first and then sell the stock.
All right, and I'll go back to Sean. Why is it important to close out the option first?
Well, that's a very good question. It's the questioner wants to convert from a very conservative strategy where you own a stock and sell an option to a very risky strategy by being naked a call. So if you place the trade simultaneously or cover the call first, you're limiting your risk because there is the opportunity for between the time when you sell your stock and you're able to buy back the option that you sold, that stock could rise significantly, exposing you to risk. So it's converting from a very conservative strategy for covered calls to having a naked position, whether it's for a few minutes or days.
All right. So the simplest thing to do is you just go in and you buy to close that option first. So it can give you some protection. The underlying market, let's say we sold an option contract for $1. If the market goes down, the good news is that the option price should go down, right? So if the option price goes down, I can buy it back at a lower price and hence make a profit on the option that helps offset a little bit of the loss that we had on the stock. But if I do want to sell the stock, I'm not locked into this position all the way to that expiration date. All I got to do is buy to close that option contract and then go out and sell the stock. Now, as Sean mentioned, or I think Tamara might have mentioned, we can do this all as one trade. If you do it all as one trade, it's called an unwind. Honestly, straight up, that's the vernacular that's used because we're unwinding our covered call position. So we're selling the stock and then we're buying to close the option. And we're going to do this all for a net credit to the account, hopefully, right? Because the stock's got to be worth something. And as opposed to the net debit when we first entered that trade. All right, I think we covered that one pretty well. Let's jump back in and look a little bit at married put, if we could, Sean. So once again, there's some very popular strategies. These strategies that we're talking about today are very basic option strategies and are where a lot of beginning investors like to start. And the main reason why is that a lot of people own stocks. And so this is one way to enhance your stock portfolio using options, not necessarily using options to add leverage and speculate on your account, but we're going to buy a married put right now or a protective put to protect us on the downside as opposed to actually selling the covered call. And then we'll actually talk about one last strategy before we get too far along. But let's jump right back into it. I don't have any other questions. Please put your questions in the chat box, everyone, if you have them. All right, Sean, back to you.
Great. Thank you, Brian. You can see the screen again here. It's the same location. It'll be research and options. I do like you using the term protective as opposed to married. I mean, protective explains exactly what this is doing. It's protecting you in the instance of the stock going down. So let's take a look here at Siri. We see it's trading at around 633. So now you want to move your eyes to the right side of the screen for the puts. So let's say we want to have protection at, say, 550. What that's saying is that if Siri's to go anywhere below 550, your put's going to increase in value. And your potential loss is stopped here at the difference between your 650 purchase price plus what you paid for this put. So double click here. Excuse me, not double click, one click because we're purchasing this put. The B here is for buy. And if we're doing this all at once, we'll be adding a stock. And you'll notice the system knows that you're buying 100 Siri. You're also buying a protective put at 550. Now, both of these transactions are costing you money as opposed to the previous example. You're paying for your Siri and you're paying a 10 cents, so that's times 100, a $10 premium for your protection. No different than buying insurance for your house or your car. If the stock wrecks, you have protection and you're not upset if you don't wreck your car, but you did have some peace of mind.
Right. And I think that's a really good point, Sean. I mean, ideally, if you're doing this a lot, some people will look at covered call or protective put buying, protective put buying, and they'll say to themselves, well, if I do this strategy, what is my outlook for the marketplace? I must be bearish if I'm buying a protective put, correct? And that's really not the case, because your best case scenario is that the underlying stock continues to go up and goes up quite a bit, right? Because if it goes up more than what you paid for your put allows you to be in that account and not be as nervous about the movement of the underlying stock, but you still get all the upside of owning that stock just in general. So married put is I would say a bullish trade overall, but nervous. That's really the best way to think of it. I have unlimited upside because I still have that underlying stock, but I'm nervous about what might be happening over the next month or two overall. And one thing about buying a protective put, a lot of people will do it a little bit more short term, because if you really are bearish, and not a lot of people will go out 6-7 months in time. Why? Because you should probably just sell the stock. Buying puts on stocks that you own is not as cheap as buying insurance on your car. The probability of the stock going down is a little bit higher than the probability of you driving your car into a tree. So insurance can be pricey. It serves a point, but a lot of people would rather do it in the do a little shorter term because of a known event, or even just the summer doldrums might be a reason why I might buy a protective put, just to try to get me through a specific time period overall, just in general. All right, so let's see how the order ticket would look, Sean.
Let's take a look here. Let me navigate back here, Brian.
All right.
You mentioned summer doldrums. Another, maybe you might be concerned about an earnings announcement. Might be another reason why. So we're adding a stock. Let's take a look and see what the trade ticket looks like. Going to preview that order. And you'll see here we're buying 100 series and buying a 750 put. Again, this will be a debit. We're paying for both, here's that term again, legs. We're paying for both legs of the trade. I'm going to cancel out here and bring us back to the dashboard.
All right. So that in general is, and this is actually where the term married put comes from. If you're putting it all in as one order sent down to the trading floor, that's when they'll reference it as a married put. Same thing with covered calls. If we're putting it all in as one order down to the trading floor, a lot of times you'll hear the industry professionals refer to it as a buy right, and that I'm buying the underlying stock and then I'm writing or selling a covered call against that position. So what Sean just showed you would be defined in the industry as a married put, and that's where that would come from. Overall, the strategy is better known as a protective put. But what's more common to do, once again, is to leg into that position. So if I'm long 100 shares of stock and I'm nervous about something, Sean, I think we'll show real quickly, how would I just leg into it and just buy a put against the stock that I own?
Sure. Thanks, Brian. That's easy. Let's say we're long series. Oh, I need to extend
that happen again?
All right, folks.
I don't know what just happened. Okay. All right. Overall, let's see if we have any other. If you have any questions, please put them in the chat box. Sean's going to be logging back into his account here real quick, but just buying a put outright from the option chains, as long as you got that 100 shares of stock in, it's no issues whatsoever. Now, one of the things to note is that if you don't have the 100 shares and you're buying a put, let's say you forgot that you sold those shares. I think that's happened to me a time or two, and you went out and bought a put option on that. Well, the system won't stop you when you're buying the put option. There's no protection in there. If you got the cash to buy it, they'll allow you to buy it and just assume that you are speculating on the downside of the underlying stock. In a covered call position, If you don't have the stock in there, the system will stop you unless, as Tamara mentioned, unless you have the ability to go naked or do an uncovered call option. So just keep those two little things in mind. When you're buying options, you are in control. You have the rights because you paid for them overall. So make sure you have that underlying stock in your holdings before you get to the option chains and just try to buy a stock outright overall. All right, Sean, let's show that fairly quick. And if you have any questions whatsoever, please put them in that chat box right now. It doesn't have to be about covered call writing. It can be about where you need to find forms on the account. How do I change the background? Any general questions that you might have, this daily customer service show is set up to try to answer them. We want to try to get you answers as quickly and as succinctly as we can here on the Ally YouTube channel. All right, Sean, are you able to get to the option chain?
Thank you, Brian. So to complete that demonstration, we're a long series. We want to purchase a put as protection. You go to the option chain. And again, puts are always on the right side. Here's that 550 put that we're selecting to purchase. And in this case, we're definitely not going to add a stock because we already own Siri. We're simply going to hit the trade button here. And you'll see that in the preview of the order, that protection is going to cost us,
well, you had a limit of 0 in there, Sean. You got to put a limit of 10 cents. That would be the ask, I guess. And in this situation, that would be $10 plus commission because it represents 100 shares of stock overall. All right. So with that said, we got time for one last question. If anybody wants to type one in there. And then I guess we'll take this last question and that'll be it for this edition of the Ally Invest Daily Service Show. I do see one last question in here. It's from Kids in Cars, and it says, when making a covered call, what is the best expiration? Well, that is kind of a loaded question. You guys got any thoughts on that, or would you like me to try to address it?
Well, that does bring up a good point there, Brian. I'd like to show you where you can see let the viewers see where they can see additional expirations.
I think that would be good. Yeah, inside the option chain, show us what expirations are available.
So from research to options, we haven't demonstrated this yet. If you look on the right here, we're only seeing the expiration date, which is for the monthly, which is July 16th. But Brian and Tamara, while you demonstrate your opinion on expirations, what you can do here is select near-term expiring, plus the 25th. You can choose, go out as far as you like on the calendar. So let's take a look at these expirations here while we discuss the merits of different expirations.
Sean, why is there a W next to some of the expirations?
I can take that one.
Yeah.
The W stands for weekly options.
Right. And that's what's nice about this is back in the day, weeklies were the new kids on the block. So what would happen is the normal monthly expiration is, in this case, July 16th. And that's what we're going to default to on our option chains. If you do not select any expirations, the July 16th, the normal monthly expiration is going to come up. Now, I say normal, that's basically the old expiration. The rule used to be back in the day that the third Friday of the month was going to be the July expiration. They have, over the years now, came up with weekly expirations, and they called it the weekly expiration because you just had 1 week. Now the weeklies go out as far as, in this case, looks like Sean is highlighting actually, 30 days out is still considered a weekly option, but it's got 39 days remaining. So they still call them weeklies, even though they go longer than than 1 week nowadays. But the option chains will highlight for you what's considered an actual weekly expiration and what's considered a normal monthly expiration. So the July 16th day is a normal monthly, the August 20th day is a normal monthly, and the September is a normal monthly overall. So the question we still haven't answered is, what is the best expiration to choose with a covered call? And in my opinion, I don't feel, you feel like it's a cop-out sometimes, but it really depends. If I'm doing Siri, which is a $6 stock, there's not a lot of time premium there. I might want to go out a little further in time because, as Sean was showing you, there just isn't a lot of juice in those option contracts. So I might need to go a little bit further out in time to be able to make it more worth my while to sell an option contract at a particular strike. So the price of the underlying will affect it, how volatile the underlying is. If I'm looking at selling a covered call on Tesla, that's going to have a little bit more movement and a little bit more juice in it than selling a covered call on Walmart. They trade at they're a little bit different as far as volatility is concerned. And so you take that into effect. I might be able to do a shorter term options in Tesla because I'm going to get paid for it because of the known volatility in that underlying stock. So ideally, when I'm looking at covered call writing, I want to make sure that the strike price I'm comfortable with, and I'm comfortable with selling that call at that strike price, and that I'm getting enough premium to make it worth my while. I mean, I've gone out and looked at, in this instance, like the July 16th, 25 days out expiration. I've looked at covered calls before and said, no, I'm just not going to do it. There's not enough premium in it. And I've looked at them before and said, wow, that's a lot of premium. It's trading extremely expensive. What's going on? Why does this look too good to be true? And so you got to be cognizant of that when you're doing the covered call writing. Overall, options are basically priced like insurance contracts. And because of that, the more volatile the underlying, the more premium you're going to receive when you sell your covered call against that underlying stock. All right. Well, if I look at the clock here, it looks like we are at the 10:30 mark Eastern time. So you do have one more. Oh, one more just popped up. There we go. Vissel said, I had a strangle. Strangle means I bought a put and I bought a call, and the IV keeps increasing. What should I do? What should I do now? Do I adjust the delta? And what's your favorite skewed strategy? All right, Vissel, that's a tough question because I don't really know. First of all, I don't know what your underlying stock is. If you're looking at and it's a strangle, which means that you bought an out of the money call and an out of the money put. If the IV keeps increasing, that's good overall. You want more volatility as opposed to less because you bought the underlying option contracts. But in general, I would have to look at that position. It's too specific, I think, for this format. And then what's your favorite skewed strategy? Well, in general, if you have option volatility and you have like large skew, which means one option contract trades for a higher implied volatility than another, it's just I prefer to do just some type of spread where I'm buying one option contract and I'm selling another option contract. So it really depends on what side of the market that you're on overall. But if I do have some skew, I want to try to sell the option contract that trades at the higher volatility and buy the option contract that trades at the lower overall. I would deem a little bit more specific situations to be able to answer that a little bit better. In particular, where is that skew and what underlying are you talking about overall? All right. Well, that's going to be it for this episode of the Daily Service Show. We do have some. We do have something to let you know about. On the 23rd, this Wednesday, we're going to be having a digital conference all day long. I'm going to be the host for the event, and I'm also going to be a speaker. And if you look in the chat box right now, there's going to be a link to ally.com/digital conference, and you can register there. And if you register, you'll get all the reminder emails. You'll get that little alert saying, you know, here's the countdown before we begin the event. It'll be going all day long on Wednesday. So please make sure you sign up for it. At least pop in for a couple of the sessions. We have some great speakers that are going to be talking on that day. And then another way that you can sign up for it is just click subscribe and ring the bell. If you do that, you will get all the alerts for all the daily service shows, and also will alert you when we have our digital conference. So with that said, I think we're going to close it out for the day. Thank you, Sean. Thank you, Tamara. And we'll be back same time, same place next week with the Ally Invest Daily Service Show. Thanks for coming, everyone.
Thank you.